The average person in America pays a higher effective tax rate than the ultra-wealthy. How is this possible? It's not about illegally dodging taxes, it's about understanding the rules of the game. We're talking about legal loopholes, strategies intentionally built into the system. In this deep investigation, we will expose the three main tactics the rich use to legally minimize their tax burden: the capital gains secret, the debt-based lifestyle, and the depreciation loop. Knowing these will change how you see wealth forever. So, let's start with the biggest one, the capital gains secret. When you earn a salary, you pay income tax. In the U.S., the top federal income tax rate is 37%. But the wealthy don't primarily live off salaries. They live off investments. When they sell an asset like stocks or real estate that they VA held for more than a year, the profit is taxed at the long-term capital gains rate. And guess what? The top rate for that is only 20%. That's almost half of the top income tax rate. Think about it this way. A surgeon earning $1 million a year from their practice will pay significantly more in taxes than an investor who makes $1 million from selling stocks they've held for over a year. The system literally rewards income from capital over income from labor, but it gets even better for them. The truly savvy wealthy rarely ever sell. Why sell and pay even 20% tax when you don't have to? This brings us to our second tactic, the debt-based lifestyle. This is where it gets really clever. Instead of selling their assets, let's say $1 billion stock portfolio, the ultra-rich go to a bank and take out a loan against it. This is often called a portfolio-backed loan or a securities-based line of credit. Banks love to give these loans because they're secured by very liquid assets, and they can offer incredibly low interest rates, sometimes as low as 1 or 2%. Here's the magic trick. A loan is not income. So, that money they borrow, it's completely tax-free. They can take out millions, even hundreds of millions of dollars, to fund their entire lifestyle, buy yachts, jets, mansions, whatever they want, and they pay zero income tax on it. They're living off their wealth without ever having to sell their assets and trigger a taxable event. The interest they pay on the loan is a tiny fraction of what they would have paid in capital gains tax. Meanwhile, their original investment portfolio continues to grow in value, often at a rate much higher than the interest on their loan. So, their net worth is actually increasing while they're borrowing and spending tax-free money. It's a strategy known as buy, borrow, die. Why die? Because of another massive loophole called the step-up in basis. When a wealthy individual passes away, their heirs inherit the assets, those stocks, that real estate, at their current market value, not the original purchase price. Let's say someone bought a stock for $1, and at the time of their death, it's worth $1,000. The heirs inherit it with a new cost basis of $1,000. If they sell it immediately for $1,000, their taxable capital gain is zero. That entire $999 of growth is never taxed. Ever. The tax liability is completely wiped out. This single rule allows for the tax-free transfer of trillions of dollars of wealth from one generation to the next. So, you can see the cycle. Buy assets, borrow against them, tax-free to live. Then, when you die, your heirs inherit them tax-free, and the cycle begins again. It's the ultimate financial cheat code, and it's 100% legal. This is how dynasties are built and maintained. The average person works for money, pays taxes, and tries to save what's left. The rich have their money work for them, and they use debt as a tool to access their wealth without paying taxes. Now, let's move on to the third major strategy, which is especially popular in the world of real estate, the depreciation loop. When you buy a commercial building or a rental property, the tax code allows you to depreciate it. Depreciation is the idea that a building loses value over time due to wear and tear. The IRS lets you deduct a portion of the building's cost from your taxable income each year, even if the building is actually going up in value. Let's use an example. Imagine you buy an apartment building for $10 million. The IRS might let you claim, say, $300,000 in depreciation expense each year. This is a phantom expense. You didn't actually spend that $300,000, but you get to subtract it from your rental income, drastically reducing your taxable income, sometimes to zero, or even creating a paper loss. You can then use this paper loss to offset other income, like from your business or investments. So, you're collecting real cash rent from tenants. Your property is likely appreciating in the real world, but on paper, for tax purposes, you're losing money. This allows real estate investors to generate significant cash flow while paying little to no tax. And the loop doesn't stop there. After a few years, when the property has appreciated significantly, what do? Do they sell and pay capital gains tax? No, of course not. They use something called a 1031 exchange. A 1031 exchange allows an investor to sell a property and defer all capital gains taxes as long as they reinvest the proceeds into a like-kind property of equal or greater value. So, they can sell that $10 million building, which is now worth $15 million, and use that $15 million to buy a bigger building, or multiple buildings, without paying a single dollar in tax on that $5 million profit. They can keep doing this over and over, trading up to larger and larger properties, deferring taxes indefinitely. It's like a perpetual tax-free growth machine. And if they hold these properties until they die, you guessed it, the step-up in basis kicks in, and all those deferred capital gains are wiped away forever for their heirs. So let's recap the 3 pillars of tax avoidance for the wealthy. First, they prioritize income from capital gains, which is taxed at a much lower rate than labor income. Second, they use debt to access their wealth, borrowing against their assets tax-free to fund their lifestyles while their investments continue to grow. Third, they use tools like depreciation in 1031 exchanges in real estate to create phantom losses and defer taxes indefinitely. When you combine all 3, you create a system where it is possible to accumulate billions in wealth and pay a lower effective tax rate than your secretary. This isn't a secret conspiracy. It's all written right there in the tax code. These rules were often created with specific intentions, like encouraging investment and economic activity. But over time, they've been mastered and exploited by an army of high-paid accountants and lawyers to create a separate, more favorable tax system for those at the very top. The complexity of the tax code is not an accident, it's a feature. The more complex it is, the more loopholes there are for those who can afford the experts to find them. Understanding these loopholes is the first step to playing the game like the rich. But the system is always changing. If you want to stay ahead of the curve and learn how to use debt as a tax shield, make sure you hit that subscribe button and turn on notifications. I'll see you in the next investigation.